Welcome to the Deep Dive, where we really get into the details behind the big financial reports. Today, we're digging into Procter & Gamble's Q1 for fiscal year 2026. That's the quarter ending September 30th, 2025. P&G, the company behind Pampers, Tide, Pantene, all those brands you see every day.
Yeah, and this report's really key because it shows us, how they're actually handling a pretty tough environment right now. P&G themselves are calling it difficult. Geopolitics, competition, what consumers are feeling. It's a lot, but they're still finding ways to grow somehow.
Right, and that's the big question, isn't it? How, because they managed to grow, yeah, but their organic volume, basically, how many actual items they shipped was totally flat, 0% change. So the growth isn't coming from selling more things. It feels like it's coming from somewhere else entirely.
Exactly. I mean, look at the top line numbers for Q1. Net sales, $22.4 billion. That's up 3% from last year. Organic sales growth, 2%. And core earnings per share, their profit measure, hit $1.99, also up 3%. Looks okay on paper.
Okay, but that 2% organic growth, you're saying volume wasn't part of that at all?
Not a bit. It was all cooked up, essentially, through financial levers. 1% from higher prices, and the other 1% from something they call favorable product mix. Volume was just static.
Okay, we absolutely have to pause on favorable product mix. P&G uses this term constantly. For anyone listening, what does that actually mean when P&G says it? In simple terms.
Right. It's basically their counter move when volume stalls. Favorable mix means people aren't necessarily buying more P&G products overall, but they are shifting to the more expensive, higher profit versions within the P&G lineup. So think like instead of buying, 5 bottles of the cheap laundry liquid, you buy 4 boxes of the fancy, super concentrated Tide Pods. You bought less stuff volume-wise, but P&G made more profit per item. That's the game. Growing profit even when unit sales are stuck.
Gotcha. So it's about premiumization, getting customers to trade up. But growth like that, it must put pressure elsewhere, right? Let's shift from just sales and look at their engine room, how they manage costs, margins, keep the cash flowing.
Yeah, this is where it gets interesting. They talk about their strategy, superiority, organization, portfolio, disruption, all that. But the pillar that really stands out this quarter is productivity. That's what basically saved their bacon on the margin front.
And you see that in the cash flow, right? Their adjusted free cash flow productivity was, what, 102%?
102%, which is just fantastic. They're converting profit into cash extremely efficiently, more than dollar for dollar.
But they really needed that efficiency because looking at the gross margin, it wasn't pretty.
No, it wasn't. Core gross margin actually dropped by 50 basis points compared to last year. Or 30 basis points if you take out the currency fluctuations.
And 50 basis points, that's 0.5%, might sound small, but on $22 billion in sales, that's a lot of margin pressure. What stopped it from falling further? Were the good guys?
Well, the productivity engine was humming. They managed to squeeze out huge savings, 140 basis points worth just from making things more efficiently. And the price increases they pushed through added another 50 basis points. So positive factors there.
Okay, so that's 190 basis points helping them out. But they still ended up down 50, so the headwinds must have been brutal.
Oh, absolutely brutal. That favorable mix we talked about, it actually worked against gross margin slightly here. Maybe people shifting within premium tiers costing 100 basis points. Then they spent more on product reinvestments. That cost 70 basis points. And the big ones, higher costs from tariffs and commodities hit them for another 70 basis points combined. Add all that up, it's 240 points of negative pressure they had to fight against.
Wow. So they found 140 points in savings, pushed 50 points in price just to offset most of that 240 points of pain.
Yeah.
That feels intense. Can they keep finding 140 basis points of savings every single quarter? Is that sustainable?
That is the multi-billion-dollar question for them, absolutely. But here's the slightly better news. Despite that gross margin squeeze, their core operating margin, so further down the income statement, held flat compared to last year. And it was actually up 40 basis points if you ignore currency effects.
Right. So they found savings somewhere else too, like selling expenses, overhead?
Must be. Because overall, they reported total gross productivity savings of 230 basis points factored into that operating margin number. That efficiency is, like you said, their superpower right now. It's keeping the whole thing stable.
Okay. One last thing before we hit the segments. Market share. How are they doing against competitors?
It's a mixed bag. Globally, their overall value share slipped by 30 basis points. Not great, but they did point out that in 24 of their top 50 specific market segments, like diapers in the US or shampoo in Germany, they either held their share or actually grew it. So losing a bit overall, but holding the line in about half of their most important battlegrounds.
Okay, that makes sense. So let's zoom in now. Where did the growth actually come from, product-wise? Let's walk down the virtual supermarket aisles, because the performance really varies wildly between categories.
Definitely. Let's start with the star performer this quarter, beauty. This segment had the best organic sales growth, a really strong 6%. And crucially, unlike the company average, this was driven by volume. 4% volume growth plus 2% from pricing. Mix was slightly negative, -1%.
4% volume. In beauty, okay, so that tells you even if consumers are feeling squeezed, they're still treating themselves with skincare, hair care.
Seems that way. The growth came from new products and pricing in hair care and personal care, especially North America and Europe doing well there. But here's the catch. Even with those strong sales, their actual market share in global skincare and global hair care both fell by a full percentage point.
A full point. Ouch. So they're growing, but the whole beauty market is growing even faster, maybe.
That's what it suggests, yeah. Okay, next up, grooming. Think Gillette, Braun.
How do they do?
Grooming was up 3% organically. But flip the story here. This was mostly pricing 4% from price hikes. Volume was only up 1%. Mix hurt them by 2%. So again, maybe people buying the slightly better razor, but it's the price increase doing the work. And their global share here also dropped 0.8 points.
Okay, so beauty has volume, grooming has price. Now what about healthcare? Things like toothpaste, cold medicine.
Healthcare was pretty sluggish, only 1% organic growth. And look under the hood, volume was actually down 2%. That 1% growth came purely from 1% pricing and 2% favorable mix. People bought fewer items, but maybe traded up to the premium toothpaste or cough syrup. Oral care share slipped 0.3 points, though personal health care gained 0.5 point.
Okay, so volume growth in beauty, kind of flat volume in grooming, volume declined in healthcare. Now for the big ones, the absolute core household stuff, fabric and home care and baby, feminine, and family care, how did they fare?
Both completely flat. 0% organic growth for both segments.
0. Wow. Let's take fabric and home care first. Tide, Downy, Febreze.
Yep, 0% growth. Volume was down 2%. That was offset entirely by 1% pricing and 1% from rounding, basically flat mix. The volume drops were particularly bad in Europe for both fabric care and home care, suggests the cost of living pressure there is really biting into staple purchases. And global fabric care share took a big hit, down narrow 0.9 points. Home care did gain 0.4 points, though.
And almost a full point in fabric care share. That's tough. Okay, and the last one. Baby. Feminine and family care, Pampers, Tampax, Charmin.
Also flat, 0% overall. Volume was flat, pricing flat, mix flat. Just nothing moving much on average.
Right.
Now, within that, they did say feminine care volumes declined, but that was offset by some pricing gains. Family care sales, think toilet paper, paper towels actually went down a bit because they were spending on promotions trying to boost sales. Share was flat for baby and feminine, but family care share dropped 0.8 points.
Man, the difference is just stark. If it's something for you, for your appearance, beauty volume is up. But if it's for cleaning your house or, basic family needs, volume is either flat or falling. They're leaning really hard on price and mixing those core categories just to tread water on the sales line.
Exactly. And that brings us back to why those productivity savings, that 230 basis points overall, were so incredibly important. It basically propped up the operating profit while sales in huge chunks of the business were struggling on the volume side.
Okay, so that's the picture for Q1. Let's pivot to the future. What are they telling investors about the full fiscal year 2026? What's the outlook?
Well, they kept their guidance ranges the same, but they're incredibly wide, which tells you how uncertain things feel for them. They're guiding for organic sales growth to be anywhere between flat 0% and up 4%. And same range for core EPS growth, 0% to plus 4%. That's a huge range.
Yeah.
It says, best case is modest growth, worst case is stagnation.
And we know why it's uncertain. The headwinds are massive, right?
Right.
What were the big numbers they called out?
Huge numbers. They expect tariffs, just tariffs alone, to be a $400 million hit to after-tax profit for the full year. $400 million.
Wow, that's enormous.
It really is. And on top of that, another $100 million after-tax headwind from commodity costs rising. So you combine those, that's $500 million in headwinds. Plus, they mentioned a higher tax rate and some interest expense, adding another 10 cents per share drag on earnings. They are paddling furiously upstream against those costs.
Is there anything helping them out on the cost side? Any tailwinds?
A little bit. Foreign exchange rates are actually expected to help them this year. They see it as a tailwind of about $300 million after tax. So,
Yeah.
yeah, currency is softening the blow from some of the tariff and commodity pain, but not nearly offsetting it all.
Okay. And with all that cash they generate, thanks to that 102% productivity, what are they doing with it?
Returning it to shareholders mostly. That's the P&G way. They plan to pay out about $10 billion in dividends over the full year and buy back around $5 billion worth of their own stock. Keeping that cash return going is really important for investor confidence.
Right. So let's try and wrap this up. The big takeaway for me from this deep dive is P&G showed in Q1 they still have serious pricing power and can push that premium mix. It worked to cover up the fact that overall volume just isn't growing, especially in their core household categories and in Europe. And their survival, their profit, really hinges on that incredible productivity machine pulling 230 basis points of savings out was heroic, frankly, given the $500 million hit coming from tariffs and commodities.
Absolutely. The whole game now seems to be, can they hit that maybe 4% growth target when costs are still rising and consumers are clearly pushing back on buying more stuff? The strategy depends entirely on getting people to accept higher prices or trade up, not just buy more units.
Which leaves a really interesting question for you, the listener, to chew on. P&G's banking on price and mix, right? But we saw their market share slipping in some really big categories: skincare, hair care, grooming, fabric care. If the overall market is maybe growing faster than they are in key areas, and their actual unit volume is flat or falling in the bulk of their business, how long can that superiority argument and brand loyalty keep driving growth just through price hikes before maybe they have to start thinking about competing more aggressively on price itself? That's the tightrope they're walking into the next quarter.